Soft Currency Economics by Warren Mosler. Mechanics of Federal Spending. The federal government maintains a cash operating balance for the same reason individuals and businesses do. Current receipts seldom match disbursements in timing and amount. The U.S. Treasury holds its working balances in the 12 Federal Reserve banks and pays for goods and services by drawing down these accounts. Deposits are also held in thousands of commercial banks and savings institutions across the country. Government accounts at commercial banks are called tax and loan accounts because funds flow into them from individual and business tax payments and proceeds from the sale of government bonds. Banks often pay for their purchases of U.S. Treasury securities or purchases on behalf of their customers by crediting their tax and loans accounts. The Treasury draws all of its checks from accounts at the Fed. The funds are transferred from the tax and loan accounts to the Fed, then drawn from the Fed account to purchase goods and services or make transfer payments. Suppose the Treasury intends to pay $500 million for a B-2 stealth bomber. The Treasury transfers $500 million from its tax and loan accounts to its account at the Fed. The commercial banks now have $500 million less in deposits and hence $500 million less reserves. At the Fed, reserves decrease by $500 million, while Treasury deposits have increased by $500 million. At this instant, the increase in U.S. Treasury deposits reduces reserves and the monetary base, but when the Treasury pays for the bomber, the preceding process is reversed. U.S. Treasury deposits at the Fed fall by $500 million, and the defense contractor deposits the check received from the Treasury in its bank, whose reserves rise by $500 million. Government spending does not change the monetary base when reserves move simultaneously in equal amounts and opposite directions. Figure 2 compares the T accounts of the banking system, the Treasury, and the Federal Reserve for a $100 million expenditure. Figure 2A shows the net change for an expenditure offset by tax receipts. Figure 2B shows the net change when the expenditure is offset by borrowing. In either case, reserve balances are left unchanged. There is no net change in the banking system when the bomber is paid for with tax receipts. When the Treasury issues securities to pay for the bomber, deposits in the banking system increase by $100 million. The Federal Reserve's use of offsetting open market operations to keep the funds rate within its prescribed range is primarily applied to changes in government deposit balances.